Good Tuesday morning and welcome to Yahoo Finance Live. I'm Brian Sazi alongside Emily McCormick. Julie Hyman is on assignment for us this week. We are seeing some mixed action in the pre-market as traders eye the upward march in the 10-year yield, pressure on tech stocks, and another hot inflation reading. All three major indices right now, where things stand, they are in the green. Now, here are three things you need to know right now. First up, another brutal reading on inflation. We just got the latest March Consumer Price Index numbers, and the CPI saw a yearly increase of 8.5% year over year. Wall Street estimated that number to be closer to 8.4%. Month over month, that is an increase of 1.2% in line with economist estimates. We could break these numbers down even more with the CPI excluding food and energy prices, which came in at an increase of 0.3% month over month compared to the 0.5% increase estimated by economists. Joining us now to go over these numbers and what they mean to the economy, markets, and your wallet is our very own Brian Cheung. Brian, so far the markets appear to be liking these numbers. We've seen futures strengthen after. Why would that be the case?
Yeah, well, what we're seeing right now is definitely in line with expectations when you take a look at that headline number from the Consumer Price Index. Again, this is just one measure of the way that the U.S. government sees price increases in this country, and that headline number coming in at 1.2% on a month-over-month basis. By the way, you don't usually tend to see more than 100 basis points of a month-over-month increase in this specific reading, which shows really just how unprecedented this high inflation tends to be. Now, of course, we also want to measure this on a year-over-year basis. So that clocked in at 8.5% on a year-over-year basis for the headline number. Again, this is covering the month of March. And when you parse out the more volatile components of obviously price increases, when you take out food and energy, what they call the core CPI, that clocking in at 6.5% on a year-over-year basis. And if there's one silver lining, it actually might be that core reading, because the street was estimating something a little bit higher than that, something around 6.6%. So actually that 6.5% core reading may have actually been a slight undershoot of what the street had expected. Now, when you unpack the components of this CPI report, obviously a big reason for the overall increase in prices in the month of March was gasoline and fuel oil. When you take a look at the specific month-over-month increase of 18.9% in the price of gasoline, over 20% for fuel oil. And this is spilling over into a number of other categories as well. When you take a look, for example, at airline fares, up 10.7%. Also take a look at car and truck rentals, up 11.7%. So all these categories that are travel related are also getting a tick up. And then owner's equivalent rent, you can see the shelter component that we're highlighting there on the right-hand side of your screen, up about 0.5%. That's going to be a stickier component because obviously those longer-term leases and mortgages are going to affect prices over the next few years as well. So guys, broad-based inflation across the board. Haven't seen these levels since 1981. I like to highlight some categories that aren't necessarily increasing. Smartphones down 4%, sporting event tickets down 6%, and for some reason, fresh sweet rolls and coffee cakes down 1.7%. So at least there's that.
Definitely an interesting breakdown there, Brian Cheung. But I'm also wondering, since you do watch the Fed so closely, what do you think this latest reading, this new 4-decade high that we got on inflation might mean for monetary policy and what we might see in May from the Fed's next meeting?
Well, it's certainly giving Federal Reserve officials no comfort that really the only category that saw price decreases is fresh sweet rolls. So for the Federal Reserve, they're obviously looking to this report and saying, well, this just reinforces our view that we have to take away the punch bowl and the easy money that we've continued to print since the depths of the pandemic. They already had that first interest rate hike in March. It seems very likely the case that they're going to do that double bump, the king size bump of 50 basis points or 0.5% in their next meeting in about 3 weeks. Of course, the question is how much higher can yields go from here? We've already seen on the 10-year, for example, that rate going up by 100 basis points or 1% just in the last 5 weeks or so. And I did a little bit of data digging to see when was the last time we saw yields rise that high, that fast? And you have to rewind to the early 1980s. So it was 1982, the last time that we saw yields going up by more than 20 or 25 basis points in a few days. And that makes sense because what was happening in the early 1980s? Well, the same story with inflation, right? The CPI print that we got this morning, also comparable to 1981. That was the Volcker era approach and policy of dramatically ratcheting up interest rates to get ahead of inflation. So a lot of parallels to be drawn between that episode and this one that we find ourselves in right now as well.